after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Group CFO, Mr. Pankaj Gupta. Thank you, and over to you, sir.
Good morning. Thank you. Good morning, everyone. On behalf of STL Group, I extend a very warm welcome to all of you for our Q4 and FY23 earnings calls. I am joined on this call by Mr. Atul Agarwal, our whole-time director, Mr. Jaideep Wadhwa, director, and SGA, our investor relation advisors. We have uploaded our results presentation on the exchanges, and I hope everyone had a chance to look at it. I will now request Mr. Atul Agarwal for his opening remarks.
Good morning, everybody. Good to connect with you guys after almost a 3 to 4 months gap. Let me just start with a brief overview of the industry. Firstly, India surpasses Japan to become the third largest auto market globally, with a revenue of 222 billion and anticipated to reach 300 billion by 2026. Two-wheelers and passenger cars dominate the market, accounting for about 76% and 17.4% of the market share. Passenger vehicles grew. We had a dramatic year. It grew by 25% this year. FY23 as compared to 19% in FY22. So I think the numbers have been phenomenal. Improvement is largely driven by growth in utility vehicles, lowering of age group of buyers who prefer innovation, high safety, and technology. The PV industry segment is expected to grow by about 5 to 7% in FY24, and hopefully this will be on the back of improvement in supply chain conditions for semiconductor products. Commercial vehicle industry grew 29% in FY23. We were supported by increased activity in road construction, mining, improved infrastructure, and a lot of spending by the central and state governments on improving the e-commerce sector. The commercial vehicle segment is expected to sustain a growth momentum with scrappage policy likely to drive fleet replacement and encourage new truck purchases. The two-wheeler segment grew at a rate of 9% as compared to a degrowth of 3% in FY22. We have witnessed growth, but production is still below pre-COVID levels. The two-wheeler volumes are expected to rise within a range of low to single mid-digit in FY24, with steady improvement in rural economy on increasing MSPs for key crops. Premium bikes are expected to maintain growth momentum, while exports might continue to be affected in the near term due to macroeconomic issues. Coming to business overview, the company forayed into EV component business with manufacturing motor control units. Currently, the EV space is a sunrise sector, and we firmly believe that it will be the next big thing in the Indian automobile industry. The overall EV sales crossed 1 million mark in FY23, and EV two-wheeler segment grew at a rapid pace. New launches in the EV two-wheeler expected to pick up, and penetration is expected to improve significantly. Scooters will become a dominant form of two-wheelers. Amidst all this, OEMs need to strictly adhere to safety regulations. We foresee multiple tailwinds in the EV space that will enable STL Group to maintain its leadership positions, coupled with a path towards achieving sustainable profitability in the future. Our revenue from EV component business grew by 3.5x from last year. This business secures more than 15 contracts, and now we have initiated capacity expansion from 300,000 units to 500,000 units per annum. Revenue from EV component business increased to 171 crores in FY23, compared to 38 crores in FY22. We are optimistic about our growth plan, and we will continue to work towards achieving our vision to become a pioneer in the green energy space. Now I'm going to request Pankaj to take over and run through the financial highlights with you.
Thank you, sir. I'll now give you the financial highlights for Q4 and for financial year 2023. Starting with the standalone numbers for Q4 of FY23 at a standalone level, total income from 140 crores in Q4 FY22 to 159 crores. This is a growth of 14% YOY. EBITDA increased by 14% to rupees 21 crores versus 19 crores. EBITDA margin was at 13.3% in Q4 FY23. PBT stood at 8 crore with a margin of 5.1%. This was impacted due to exceptional items pertaining to liability of 3.29 crores we recognized on the foreclosure of our EPCG license. If the said exceptional item was not there, the PBT margin was 7% level. That stood at 5.3 crore. FY23 complete year on a standalone level, the total income grew by 27% to 604 crores in FY23, up from rupees 475 crores last year. EBITDA increased to 92 crores FY23 vis-a-vis 73 crore, which is about 26% growth in the EBITDA. PBT and PAT grew by 43% and 39% respectively to reach to 57 crores and 41 crores in FY23. Coming to the consolidated financials, equally good year or better. Q4, we had total income increase from 170 crores in Q4 to 203 crores, which is 25% increase in the quarter. EBITDA increased by 30% to rupees 23 crores, which is 18 crores previous YOY. EBITDA margin increased from 10.6% in Q4 to 11% in FY23. PBT increased by 10%, is 10 crore in Q4. PBT margins were at 4.7%. PAT increased by 13% YOY to rupees 8 crores over 7 crores. The full year on a consolidated level, total income increased from 513 crores, all-time high number of 775 crores, which is about 51% growth in the total revenue of the group. EBITDA has increased by 44%, and we have touched 100 crore EBITDA absolute number first time in the history in FY23. It was 70 crore last year. PBT also surged by 82% and at a 63 crore level, up from 35 crore last year. And the margin also increased to 8.2%. That increased by 87% to 48 crores in FY23 over 25 crores in FY22. That margin also improved from 5% to 6.2% in FY23. Thank you very much. We may now begin with question and answer session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepan Sankara Narayanan from Trendlyne PMS. Please go ahead.
Good morning, everyone, and thanks a lot for the opportunity. So firstly, from my side, so what will be the impact on FY24 EV volume sold with this EV subsidy controversy of government and the pending investigation on these players? So what kind of impact we are expecting? And also, what is the impact on our customers? And is there a possibility of Ola gaining more market share from current levels?
Okay. Good morning.
Guys, I'm going to hand this over question to Jaydeep. Jaydeep is the director on Sterling Tools. He's also the managing director of our EV business.
Okay. Good morning, everyone. I think the first question that you asked was, is Ola going to be able to gain more market share? I don't think we are the right people to answer that. Those are questions that would be best asked from Ola and the other OEs. We think it's a great company. They've got a lot of new product offerings in the pipeline, and they have very ambitious plans and a lot of capacity and a lot of drive. But how it actually pans out in the market, I think I would leave that to the OEs to decide. Regarding the FAME subsidy, people expect that the FAME subsidy at the current run rate could run out sometime by the end of October or November this year. The expectation is that maybe the government will extend it till the end of March. What we understand from most of our customers is that they are working very hard to offset some of the losses if the same subsidy is not extended further. And these are again decisions for the government to take. But if the subsidy is not extended further, I believe the OEs their strategy will be around cost optimization to a large extent, and there are some tailwinds there that will help them. For instance, there is excess capacity for batteries in China right now, especially in the formats that are currently used in two-wheelers. So as compared to, say, a year ago when a company like Ola was air freighting batteries from China, you have a current position today where the cell manufacturers in China are willing to lock in prices for the next 2 to 3 years because of excess capacity that is available with them. So I think that's going to give our customers and the industry some benefit. They're also working very hard on cost optimization. Volumes are helping, and there may be still even after all these optimizations, there may be a price increase that the customers may have to pass on to customers to maintain similar levels of margin. We believe, as do our customers, that now that the young customers, the early adopters, have seen the benefits of the EV, have seen the riding experience, have experienced all the user interfaces that EVs offer, that trend will continue. I think the government's subsidy has done its job in that it's made EVs very popular. And now it's not only. I think people understand the benefits of the electric vehicles, and if we can continue to make the total cost of ownership attractive, which I believe the industry will be able to do, the industry will continue to grow even without a subsidy if the subsidy is withdrawn.
Okay, understood. So what will be our revenue growth outlook for this EV business for next year? So where will this growth driver coming from for us?
Yeah.
Which is only from this first customer, or we are extending our volumes to the second or third customer? So that understanding will be helpful.
So I think we've discussed this earlier, that we have 15 customers who have given us confirmed contracts. Now, volumes on these customers fluctuate a little bit because of various reasons. Again, you have to understand that EV industry is nascent. In the recent months, a lot of volumes have been impacted because of the fact that the government changed the battery standards. And most companies, really had to scramble to comply with them. But as this is now all being settled, we expect that these customers that have given us orders, which is across two-wheelers, three-wheelers cargo, three-wheelers passengers, and LCVs, we will see volumes go across. Now, I do believe that the growth potential for our business is at least 2x from where we are today.
Okay. And one more question on the EV side. So we have seen a sharp jump in gross margin for EV business. So is that due to product mix changing or some RM price cut which has helped this quarter?
So if you look at the overall EBITDA margin, that hasn't changed much. So there's also a bit of, in the way we were reporting earlier, we were reporting a lot of the job work that we were doing in cost of sales. We've now restated that into other expenses. So I think that's made a difference. So you'll see that most of the jump in the gross margin, as you see, is a lot of it is offset by an increase in other expenses. So net, the difference, there is not much difference between the two quarters. and the margins as they are stable. We continue to work on further cost optimization, but it's not something that is going to give us a very big jump, from quarter to quarter. It's something that will be incremental and continue to work.
Okay. So lastly, from my side, what is the reason for sharp increase in this consolidated other expenses to 64 crores?
So I think I'll let Pankaj answer the question of the sharp increase in consolidated other expenses. Obviously, there is some contribution in that from SGM because of the factors that I just explained, but Pankaj will go into greater detail.
Yeah, so I think Jaideep answered console increase in other expenses on account of EV vertical only. So nothing on the standalone, no change over there.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Good morning, sir, and thanks for the opportunity. So, a few questions from the partner business. So, there is a sharp fall in the margin in partner business. Is it because of the old inventory, or there are the other constraints, like that jump in the power cost and other things?
Yeah. Good morning, Abhishek. Let me take this point. So, we're talking about the quarter 4, right?
Yeah.
So, quarter 4 has one-timers. So, there was the whole year we touched 600 crore turnover. There's annual volume discounts which we pass on to the customers. That has been provided in this time. And some year-end provisions also we have made. And the steel prices came down as a part of which the inventory evaluation impact is there. So there is no concerning item on the margin drop in quarter 4. We continue to on a yearly basis, if you see there is hardly any change. We are pretty stable, and these are one-timers in the quarter 4 which has pulled the margin down.
So, given the lower steel prices scenario, your margin is always between 17 to 18% kind of the number in partner business. This time it has gone down to 11%, and as you are mentioning, there are some inventory adjustment and other provisions. So, if we normalize all these things, what would be your margin in the first quarter FY24?
Just to correct the data, so it's not dropped to 11 ever. Anyway, we can discuss that offline. But yes, our margin of EBITDA around 15.5%, which is the yearly average, is where we are today. And we think that's a number to consider.
Okay, sir.
So if I can add to that, firstly, I don't know where the number of 11% EBITDA has come in from. I think there may be some communication gap, or you can take it up with us offline and run the numbers with you. Secondly, to add on to what Pankaj said on Q4 numbers, let me just say, yes, it's down percentage or 2 points vis-a-vis Q3. And Pankaj explained what the one-time issues were. But I would rather focus on the full year EBITDA margins, which are still healthy, despite the fact there's a numerator-denominator effect, inflationary issues on the balance sheet in FY23. Now, having said that, steel has softened. Steel has softened, but that does not mean steel has softened, giving us dramatic savings. But the trend is on the lower side. There has been a marginal reduction in steel buying prices, but it's not dramatic enough to make a substantial margin impact for next year. Having said that, if I can just spend 10 seconds on next year, we believe our margin structure for FY24 will be better than FY23 on a full year basis. Quarter on quarter, we have issues on inventory valuation depending on RM or other inflationary issues. But on a full year basis, I think our guidance will be that margins improve over FY23.
So, sir, what is your margin guidance in the revenue and margin guidance for FY24, sir?
For fastener business?
Yes, sir, fastener business.
So I think we are at 15% plus right now. I think we'll be close to 16% or so.
16%. And top line growth, sir? I mean revenue growth?
So we are looking at for top line growth. Let me just I want to dive into a lot more data before I get into the guidance. Let me just say that the industry going forward, like I said in my opening remarks, PV industry is expected to grow at 5% on a more aggressive side, but that's our estimates, but most indications by CM or other industry bodies are looking at about a 2 to 3% industry growth in PV segment. Farm equipment is expected to be flat, and two-wheeler industry is up maybe 9%, but that's also changing the mix. What's happening there? Two-wheelers also not expected to grow to anything more than about 5% or so this year. So keeping in mind industry growth, I think we are looking at growing anywhere between 17 to 20% for next year.
So how was the mix for the fastener revenue in terms of the two-wheelers, passenger vehicles, CVs, and
Can you say that again, please?
How was the mix for the fastener revenue in terms of the two-wheelers, passenger vehicles, CVs, and farm equipment in FY23, sir?
So, okay, have the numbers in industry segment ratio.
Industry segment ratio.
Give us a second.
Yes.
So I think just to give you a sense, while Pankaj is opening the data for himself, we are at in FY23, we are at about 20% in two-wheelers. In passenger vehicles, we are about 24-25%. Commercial vehicles, we are at a similar number. Farm equipment is at about 11%, and aftermarket is at about 14-15%. Just to give you a sense where we are. So I want to dive into another data point out here, which is I didn't mention that the commercial vehicle industry grew 29%, but our revenue in the commercial vehicle segment has gone up by 62%. Two-wheeler industry grew 9% last year. We have grown 36%. Farm and tractor equipment has grown 12% last year. We are up 36%. Passenger vehicles are up 25% last year. We are up 35%. Overall, we are up 28% in revenue terms over last financial year. I just wanted to put that data out there that Sterling has grown faster than the industry in all segments of the business, and I think that's why we have grown for 28% in revenue terms in FY23 over FY22. Yeah.
Great, sir. What is the volume growth, sir?
Excuse me, sir. I would request you to kindly rejoin the queue, sir. There are many other participants who are waiting for their turn.
Okay, I'll come in.
I request you to. Yes, sir, please. Thank you. The next question is from the line of Sonal Gupta from HSBC Mutual Fund. Please go ahead.
Hi, good morning, and thanks for taking my question. So just coming back to the margin side, right? Like a couple of quarters back, you guided that the fastener business margins would be in the range of 16 to 19%, and I would imagine that these annual volume discounts are seems like an annual practice, so this should have already been worked into your estimates. So just trying to, and now you're talking about 16% EBITDA margin, which is the lower end of your guidance. So just trying to understand what has changed here in terms of your cost structure, etc. And like you just mentioned, I mean, like you are gaining market share, you're outperforming the industry in all segments. So just trying to understand why the sort of downgrade on the margin expectation.
So a good question, Sonam, but let me just say, yes, our guidance is always between 16 and 19%. We are giving a guidance of about 60% for FY24. But I want to your question of a past guidance, Now, there are 2-3 big factors. One is a mathematical issue. Steel has gone up by roughly about 23,000-24,000 with a metric ton, which is almost 35% from the base prices. Now, just because of that mathematical numerator-denominator effect, we have got full compensation from our customers for steel price moving up. But just because of the mathematics, the way it plays out, the margin structures fall. For example, on a low base of steel, our margins were about 18% plus. If we keep a similar cost structure and the steel goes up, there's a numerator-denominator effect of about 2.5-3% on that. So that's causing additional pressure mathematically more than anything else. Second part of the equation which gets impacted is because of inflationary cost pressures, where costs have gone up on other inputs, would be chemicals, energy, people, etc., etc. In FY23, we were working with a lot of customers to give us price increases. Those price increases were a long time for negotiation. We've been able to conclude a lot of the price increases with our customers, which are kicking in either in 1st April this year or which have kicked in just a couple of months ago without giving us a full year impact. So I think that those price increases on account of inflation cost increases on top of steel price increases are going to kick in for this full financial year. Now, having said that, I would still give a guidance of 16%. Once the steel prices soften more, I think this can go up to 17-18% from a more normal range. But from the current indications we have, steel prices are not expected to soften so much to give us that benefit. Thirdly, what I would say is that this year the industry is only expected to grow in the commercial vehicle segment only. We don't see much growth coming in other areas. And having said that, we are still giving a guidance of 17-18% revenue growth this financial year. So the numbers, what you're hearing from me on 16%, I will not say it's a change in guidance. I would still say it's very much in line of 16 to 19%. And if that steel softens a bit, then numerator-denominator effect will automatically bump it up to 17-18%. If you like, and I'll tell Pankaj to set up a separate call with you just to explain to you how that equation works.
Yeah, great. Thanks a lot, Atulji. So the second question I had was on the sequentially, if I look at the which is the EV business essentially consolidated, revenues have also been flattish. So it seems to indicate that the EV revenues have been also sequentially flattish, despite the fact that we've seen clearly one of your largest customer having a significantly increased sort of shipment, etc. So just trying to understand that why have we not seen a benefit in terms of revenues?
Okay, so we've grown between Q4 22 and Q4 23. We've grown 83%.
I was talking Q3 to Q4.
I know that. Now, if you look at, I know that one of our large customers has grown in the low double digits between Q3 and Q4. Okay, but you have to, and we continue to have 100% share. There is a difference. I mean, what is inverted what is inverted by the customer, what their stocks were. There is some level of fluctuation that takes place. Okay? So all that we are seeing there is that we had the stocks at the beginning of the third quarter at our customers' place was significantly higher than the stocks at our customers at the end of the fourth quarter for a number of reasons. Both customer and us are trying to get back up to a higher level. So you will see that we will possibly have higher shipments to them in this quarter than they will have to their end customers. But I think quarter over quarter there will be, there are some changes that take place, and there are a number of factors for this. But there is, we continue to be 100% of the business, and it's just like I said, factor of their inventory movements and the way their productions have panned out versus how our productions have panned out.
Got it. And if just on this, I mean, the last question I had was, when do you see the three-wheelers and LCVs sort of customers, the orders that you won sort of ramping up? When do you see the launches happening?
So three-wheelers have already started moving up fairly well. I think, and I think we've had a good quarter in the fourth quarter. LCVs are we don't see volumes really picking up, till probably the third quarter of this year. Right? What we are selling is in tens and low hundreds. It's not in the thousands.
Got it. Great. Thanks a lot. I'll join back the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. And I have only one question because most of the questions already answered by the management team. So for the quarter 3 to quarter 4, the rise in the other expenses, what is the component of one-off in that rise of incremental numbers?
You're talking of EV console level or standalone?
I'm talking of consolidated other expenses line items, sir.
Sorry, just can you repeat? You are talking of standalone or console?
So I'm talking about consolidated financials, sir, and I'm talking about other expenses movement from quarter 3 numbers to quarter 4 numbers. So there is a substantial increase. So what is the one-off component in that?
So if you see the published results, I think other expenses this time is including power and fuel and consumption of store and spares. That's a presentation part. I hope you have factored that in.
Yeah.
Besides that, as Jaideep just mentioned, in the EV business, there is the expenses relating to which costs has come down and other expenses have gone up. So the nature of those expenses is like job work, selling and distribution expenses, labor cost, and general administration expenses, because there's a ramp up in SGEM. So these expenses are falling in other expenses, and that is the reason it is going up. What we should also see is that the proportion overall, there is no impact.
Well, you were talking on the one-off cost. Or what is there any quantification of the number, sir? One-off cost and other expenses.
The details which are available, and it will broadly as a item. These are heads which I mentioned.
Okay, sir. Thank you.
Just for your better understanding, as I said, it has job work, selling, distribution, labor cost, and general administration expense.
Yeah. I better understand you clubbed the many expenses this quarter. Better understand that. But if you take the operating margin movement from the quarter 3 to quarter 4, there is a substantial drop. So that is
see the year as a total will be a better picture. And as I said, because of the volume increase in the electric vehicle segment, these expenses in absolute term will go higher.
Sure, sir. Thank you. Thanks a lot. Thank you.
Thank you. The next question is from the line of Viraj from Simple. Please go ahead.
Yeah, hi.
Sir, your voice is a little bit muffled. I would request you to use your handset, please.
Hello.
Yes, sir. Please continue.
Yeah, just a couple of questions. First is on the fastener business. You talked about outperformance for us in FY23 versus various end segments. So is that value outperformance, or you're talking in terms of volume?
Let me take that up, Atul here.
Hi, sir.
We are up 28% in revenue, FY23 in our fastener business. 21% has come through volume growth. 7-8% has come through a combination of price increases and product mix improvement. That's just to give you an overall company data point. Secondly, the values which I've shown increase, they're substantial increases. For example, I mentioned commercial vehicle is up 29% as an industry segment. We are up 62%. So these outgrowing each segment is substantially on account of volume increase we have been able to achieve because of new product development which kicked in, new negotiations we did for our customers for share of business changes, etc., etc. So we are up across all the 4 segments in the automotive industry because of the same reasons.
Okay, and when you say 17 to 20% growth in FY24, despite the industry being muted, that's at the fastener business level, or you're talking more at the consolidated level?
So I'm talking on the fastener business level.
Okay, so again, that will be largely volume growth driven, right, sir?
That will be largely driven through a combination of new product development, share of business changes in our favor from customers.
So if you can just provide a little more granularity in terms of, various end segments, what will our share be now with major customers? How has that changed in the last 1 or 2 years? That will be very helpful.
So just to give you a sense, let's talk about, if I talk about two-wheeler segment to start with, there our share of business has marginally improved, or we have been able to maintain with the largest customer, which is Honda Motors and Scooters. We were able to acquire a lot of new business at Suzuki Motorcycles, which is part of Suzuki Group. I think that business went up almost 50% for us over last year. That gave us a huge bump in our business. If you look at in the passenger vehicle space, we were up 35%. We've been able to grow marginally again with our main customer Maruti Suzuki, but we were able to grow substantially in Mahindra and Mahindra's automotive division. We had done a lot of product development work with Mahindra over the years, which translated into substantial volume and value increase in this financial year. As we all know, Mahindra has done very well in this automotive division. So I think those are 2 reasons. In farm equipment, we were always a strong player with Mahindra. We have grown dramatically in Mahindra tractor division, and we had acquired John Deere as a customer 2-3 years ago. Those values for new product development kicked in FY23, which will improve in FY24. So those are the 2 big reasons where it went up. Plus, we did business. Our business with off-highway with JCB has also gone up dramatically. We are up almost 100% with JCB. Again, on the back of new product development and work we have done in the last 2-3 years. In commercial vehicles, industry is up 29%. We were up 62%. Growth came on the back of Leyland, where we have done a lot of new product development in the last 2-3 years, where the values have gone up. I think we are up with Leyland almost 100% over last financial year. We are up about 35% in Tata Motors, and we are up about 40-odd% in Volvo trucks as well. So, in summary terms, all I can say is a lot of new product development work done in the last 2-3 years that has kicked in. Plus, because I think we were able to work with the customers to improve our share of business across board.
So just to kind of go a little deeper on this, and just 2 parts of this. One is, as you said, it takes a couple of years for the new product development and to kick in and to materialize. So based on the efforts which we are making in the last 2-3 years, even if the industry volume were to remain subdued, or even in that environment, do we have enough pipeline in place which can keep us sustain this growth rate, say not just in 24, maybe even in FY25? And a related question is also in the sense in terms of margin. So when we kind of bid for these new projects which we are looking to commercialize, inherently, I mean, in the past also we have been very conscious in terms of the profitability in the products which we bid for. So in that sense, there is no change in those margin thresholds which we traditionally looked at before, when we look to bid for new projects.
So let me answer your first part. Yes, you're right. It takes 2 to 3 years for a new product to translate to value. The guidance we have given for FY24 on revenue growth is, despite the fact the industry is not growing, and going forward for FY25-26, we are already working on product lines where we have visibility as to what is going to kick in terms of value and bump up revenue for us. So I think we'll share with you as we go forward in the year Some stuff I can't share with you right now because of competitive reasons, but I can only show you that our revenue growth plans for FY25 and FY26 is also robust, keeping in mind the activities we have going on. On your second part of the question, you just refresh me again, was on, can you refresh me the second part of the Yeah, so on the margins, so yes, as a company philosophy, we believe in that margin retention is very critical in what we are trying to do. So our philosophy remains the same. We are not compromising margin structures to find this growth. We are looking at more and more critical part development. Will help us not only in margin retention, also improve our competitive position with our customers.
Okay, that's good to hear. Can I just squeeze in one more question? On the EV part.
Please, sir, I'm sorry to interrupt, sir. I would request you to kindly wait for follow-up questions, please.
Sure. Thank you.
Thank you, sir. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good morning. Thank you for taking my question. So my first question is that we're talking of 17-18% growth on the fastener side. That means we'll be anywhere between 700 to 750, which I believe is the peak revenue we can do. So do we have any incremental capex plans on the fastener side?
So I think we're investing 30 odd crores incremental capex this year. I don't have the exact number, but guidance will be between 25 and 30 crores. So yes, we are adding incremental capacity for certain specific products and certain balancing equipment. So that's an ongoing capex. That's an ongoing capex we are doing, which will supplement capacities. But I think our revenue, we had given a guidance of, some time back of maybe, I think about 800 crores. We are not given a revenue guidance of 750 on a full basis. My sense, if I remember correctly, is more like 800 crores. And this may be before we had price increases kick in. So this number may be north of 800 as well, including the capex we are doing this year, and going forward we will do incrementally to support the growth of the business.
Sorry, just to clarify, this 800 crores is including the 30 crore capex that we're planning to do this year?
No. I think 800 crore capex is based on the old numbers. The 30 crore capex is on top of that, and which will help us increase our capability to grow beyond 800 and do certain other products which are not currently, our equipment is not currently capable of manufacturing.
Understood. On the fastener side, we said that apart from the annual volume discount, we also had some amount of inventory loss because of reduction in steel prices. Is it possible to quantify what is the inventory loss for the quarter?
No, I don't. I think Pankaj, I don't know you guys can agree with me, but my sense on the inventory loss is not an inventory loss. It's more of a valuation exercise loss. Pankaj, you want to explain that? Arun, you want to take it over?
Yeah. So basically, whenever there are steel prices changes, it gets reflected in your closing inventory, and we say to the large inventory, the valuation change is what is captured in quarter 4. So there's no loss per se on inventory. It is a valuation which is having an impact. And these are timing differences. As you move forward, prices change. Again, these things will keep reflecting in the results.
Is it possible to quantify this amount?
I think it's a bundle along with right now I don't have number to share with you. Maybe we can connect offline to discuss this.
So if I can add on top of what Pankaj is saying, these are valuation exercises which are done quarter to quarter. So that if you will find some quarters the cost of inventory goes down, some quarters goes up, depending on the buying practice we have done in the last quarter or the quarter before that, because there's a large pile of inventory at finished goods level. There's an inventory at our work in progress level, which is revalued quarter on quarter depending on the buying prices and cost of production for that quarter. Yes. Yeah. So yes, the quarter. At times the quarter may look bad. At times the quarter will look very good. So what we trying to do as business owners here in the business is we like to focus on the annual numbers, which are more representative of the true nature of the numbers.
So while I understand that it will be different from quarter to quarter basis and it makes sense to look at the annual number, just trying to understand if this is start of a new trend with reduction in steel prices, where the margins can be. My last question is on the consolidated side, we've done about 10.5% kind of margins. And for fasteners, we've said that we're looking at doing 16% lower end of our band for 24. On console, what is the kind of sustainable margins we can do?
So for the quarter, yes, if you see the blended for the complete year on a console is around 13% EBITDA margin, right? As we advise on a fastener business, margin should be in the range of around 16. And for the EV business, we currently are at a 6.5% EBITDA margin for the last year, and 6.5 to 7. And our as we move to the next year, our advisory earlier was also in the range of 8 to 10%. So there is going to be about 2 to 3% improvement in margin in EV, about 1% of margin in fasteners. Blended, whatever comes will be an outcome of that. So it will definitely be better than 13%.
No, I think also if you look at the mathematics in the last quarter, the EV business did a revenue of roughly close to 60 crores, which is almost 30% of the revenue of fastener business. In a fastener business, we did 150 crores and 33%. So, and EV did close to 60. So about 35% revenue as a percentage came from the EV business. Now, that automatically, mathematically, the ratios change and that puts pressure on the consolidated margin structures. And having said that, these margins are expected to go up. I just want to mention, since you're talking about margin structures, we got to keep in mind the two separate businesses, fastener business and EV business. I think one data point we need to address would be return on capital employed. And I think the return on capital employed in the EV business is dramatically better, despite the lower margin structures in that business. That ROCE there in that business is about 35% in FY23. So I think we need to factor in and we need to keep an eye on ROCE as well as margin structures while looking at the business overall.
Okay, thank you.
Thank you.
Thank you.
Thank you. A reminder to all the participants, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Chirag Setalvat from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good morning. Just a clarification on the growth numbers. So, on one hand, you mentioned growth of 17 to 20% in fasteners, and then subsequently there was a number of 800 crores. And if I get this right, your fasteners revenue is roughly about 600 odd crores in FY23. So, if you could help clarify that.
No, so I think the question by one of the members on this call was 800 is what the number they're understanding on a full capacity basis. It was not for FY24.
Okay, so that's on full capacity you can do 800 crores.
800 plus. Like I said, we are doing incremental capex this financial year. So the guidance on a full capacity will be 800 plus, not much north of 800.
Sure. So the guidance is for this year is for this 600 odd crore revenue business to grow by 17 to 20%.
Correct.
Right. The second is on the EV business. Can you help explain the competitive advantages that the company has? Because my extremely limited understanding, I'm not sure how value added this product is. How much is, what is the sort of value add the company is doing, and how easy or difficult is it for competition to enter into this area?
Okay, so obviously. Let me first start by just explaining, and I hope I'm not being too repetitive for all the members on the call. The motor control unit, is a factor. And I'm talking, and the architecture differs from different vehicles and different vehicle classes. But let's just talk about a high-speed scooter because that's where the bulk of the market is right now. In a high-speed scooter, the motor control unit basically interfaces with the battery pack and the BMS there. It interfaces with the vehicle control unit. It drives the motor and it interfaces through the vehicle control unit with the instrument cluster. So the most important part of every part of a vehicle is important, because without everything coming together, it doesn't work. But the motor control unit has a large software component to it, both which drives the performance and efficiency of the controller, but also the overall vehicle performance. So and that's a differentiator in some ways. And that's why we've also talked about the fact that there is a lot of stickiness, because while it is possible to replace a controller, there's a lot of software work that is required to do so. Because of all the interfaces that are there with different aspects of it. In terms of the value add, and what is our competitive advantage, we understand, with the 3 years since we started this company and the 5 years since we've been working on this project, we understand the competitive landscape. We understand, the vehicle architectures very, very well. We understand what is required to get the vehicle to do what our customer, which is the OE, wants it to do, and our ability to provide that engineering support to the customers and to get the vehicle to where they want it to be, I think is a key factor, and there's a lot of experience that's been built in. We've developed an ecosystem of suppliers to allow us to ramp up to the volumes. We've gone up pretty much from a standing start to 180,000 units and more, and we're continuing to expand. We've locked in suppliers for DSPs, MOSFETs, and other key components. So we built an ecosystem that enables us to be able to cater to our customer requirements. So at the end of it, we've got the engineering edge out there, and we've got the supply chain and the ecosystem in place. So yes, there will be competition. Competition will increase, no doubt about that. But we will, I think we are well placed to be able to maintain our competitive advantage in this space.
And where do you see revenue? Last question from my side. Where do you see revenue in the EV business this year?
I mentioned earlier that we are looking to at least double.
And this year was 170 crores, right?
Yeah.
Great. Thank you very much.
Thank you. The next question is from the line of Chirag Shah from White Pine Investments. Please go ahead.
Yeah, thanks for the opportunity. Sir, I have first a few housekeeping questions or other clarifications. So one, when I see your presentation, you include other income in your EBITDA calculation. Is it possible to indicate what exactly it is? Because when I look at the annual report, a large part of this appears to be treasury income, fixed deposit, interest, and all those kind of things. So that is first question, because if we exclude other income, then the pressure on margins seems to be slightly higher, either annual or quarterly. So that is one. That is the first housekeeping question.
So yeah, other income is interest on treasury, scrap sale, and this time we had about 2.5 crore of dividend we received from Haryana Ispat, our subsidiary company. So this is not a substantial amount. In terms of percentage margin, yes, you can compute with revenue from operation basis than total income. In fact, the margins will improve if you do that. The denominator is going to reduce, right?
Okay. The second question is, you indicated that there was some mark-to-market valuation negative impact on inventory. So in the past, is it that we also had a positive impact on quarterly basis because when steel prices were going up?
Yeah, that is true, because that is how the steel behaves, and that of course there have been benefit in the past.
So as a request, sir, if it's possible, if you can highlight that in presentation, whether a gain or a loss, it will help us to understand the quarterly numbers also reasonably better. And the last question, if I can, this is more on the product side. So on the fastener side, you indicated that there have been market share gains. For example, in Ashok Leyland, you indicated, in M&M, you indicated. because of product development. Can you indicate what these products were? What kind of products were you referring to?
So the same fastener, if you look at any vehicle for that matter, there are about 300 different kind of part numbers, SKUs which go into making a vehicle. So we have not developed, or no the fastener maker has developed the entire range of 300 fasteners. So that development activity is an ongoing one, but we try and focus on more critical parts to do that. I think that has given us customers are already buying that from competition, or maybe it is for a new product or a new model they were launching to replace an old model. It's a combination of those things.
Okay, so what I was referring to is, are there more engine-related fasteners or chassis-related fasteners which you can indicate, or are they very different in terms of the thickness or the fine-tuning that you do? Are they far more that you are not making? So what exactly are these? And going ahead, what kind of development you are making without going into the strategic information which you can't share?
Yeah, so these developments are more for transmission and for engine application.
For transmission engine applications. And we assume that this process will continue. It was not a one-off thing, right? So
it's an ongoing process. And that's how we are able to do what we do. It's an ongoing process.
And I'm referring to the pace. I was referring to the pace. The way we have scaled up over the last 2 years in terms of market share, and I'm referring to volume market share in general. I'm more referring to that perspective. So that process continues.
Process continues, and in fact, our objective is to intensify it more and more going forward.
And does that have a negative rebound on your margins in the initial phase, in say year one or something like that?
Can you repeat that question?
So the new SKUs that you introduce with the customer, does it have a negative impact on margins in year one when you introduce them? So suppose you introduce